Before closing the course, it's important to be explicit about the limitations of the models we have used. Market risk models are useful tools, but they are not objective truth about the market. Understanding the limitations is a critical part of using them responsibly. Several of the models we've used rely on distributional assumptions. In particular, parametric valued risk assumes normally distributed returns. In reality, however, financial returns often exhibit fat tails, skewness, and also regime shifts. During periods of market stress, these assumptions can break down precisely when accurate risk estimates matter the most. Historical-based measures such as historical VaR and tail risk depend entirely on past data. This means that events which have not yet occurred are by definition not captured. Risk estimates can also be sensitive to the chosen sample period, leading to materially different results depending on the historical window or lookback you've used. Another limitation relates to correlations and market dynamics. Many risk models implicitly assume that correlations are stable over time. In stressed market conditions, correlation often increase, which is reducing diversification benefits exactly when they are the most needed. This effect can cause portfolios to behave very differently from what historical averages would have suggested. Valued risk by construction provides no information about losses beyond the chosen threshold. And if you have understood that, you already have taken a lot from this course. As we've seen, tail losses can be significantly larger than VaR estimates. Extreme losses also tend to cluster, which further challenges simple risk models. It's useful to distinguish between market risk and model risk. Market risk arises from market movements themselves. Model risk arises from simplifying assumptions, estimation error, and incomplete representations of reality. Poorly specified models can create a false sense of security, even when markets behave normally. The practical implication is that risk models should be treated as decision support tools, not as guarantees. They should be monitored, challenged, and completed with judgment and additional analysis. No single model provides a complete or permanent description of market risk.